I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Axel Merk with the investment company of the same name, Merk Investments, with $400 million under management. Axel Merk, good to have you on USA Watchdog.
Great to be with you, Greg.
Well, you wrote a piece back in February about how to make money under a Yellen Fed, and I put you down on the list, and lo and behold, and I thought, wow, Janet Yellen was going to be a bit of a hawk, not so dovish in her congressional testimony. Well, earlier this week, Monday, she removed all doubt that she was a dove. Tell me about Janet Yellen saying that, at the Fed, our goal is to help Main Street, not Wall Street. I thought, what?
That's her key mantra. She said that at the confirmation hearing as well. I mean, she's from Berkeley, our neighborhood. I'm based in Palo Alto, and it's all about warm and fuzzy feelings. Ultimately, of course, there's only so much that the Fed can do for Main Street. My view is actually the Fed is the main contributor to the growing wealth gap that we have in the U.S. When you have free money, easy money, hedge funds can do great with it, but when you're lured into credit, you fall down the cracks. But yes, she wants to help Main Street, which conversely means she may be far more interested in regulatory policy to force banks to do certain things. And you see that as well with the answer she gives. She doesn't know the definitions of what a full-time employee is. She doesn't know how many mortgage-backed securities the Federal Reserve has. So in return, she's far more excited, you saw that during her testimony as well, talking about the competitive positioning of banks and things like that. So she is more interested in Main Street, which means she's more interested in regulation than necessarily worrying about interest rates.
Well, yeah. One of the Fed governors said that the QE was a giant gift to the wealthy. Just recently, I think it was the Dallas Fed. Somebody
of
did.
Course, and the background to that is, of course, the reason why the Fed wants to boost asset prices is because millions of homeowners are underwater, and by pushing up these asset prices, we are no longer underwater. The reason that's relevant is because the U.S. economy is very consumer dependent. Consumers underwater in their home are not good consumers. That's why I want the prices to go up. And sure, the stock market goes up at the same time. And if you have assets, if you have money, you have done great with this Fed. Main Street doesn't exactly qualify for that. But the reason why they're pushing up asset prices is to bail out homeowners,
including housing prices. But housing has taken a bit of a chunk down here. That it's not doing so hot. I mean,
it shows that asset price inflation is not sustainable, but a very fragile policy because that can evaporate at any time. At the moment the taper talk started, the new home sales, existing home sales, all of those deteriorated because guess what? As interest rates move up, you have to pay more for your home. Now, clearly, those mortgage rates have come down a little bit, but the signaling is out there, and home buyers are not coming, and that's a big problem for the Fed. It's one of the many reasons why we're not going to have an exit anytime soon.
Do you think the easy money policies are going to continue? You think QE continues? Do you think they're going to reverse course? Some people are predicting they'll reverse course as the economy starts getting worse and worse, that they'll reverse course and they'll pour coal onto the fire and they'll run it back up going into the 2014 midterms.
It might at some point, but keep in mind, we're going to get, for example, Stan Fischer joining the Fed Board of Governors. And Stan is somebody who says that the key role of the Fed is to ignore noise. And so another way of saying that is that you're going to try to be as stubborn as possible. I listened to a presentation of his about 2 weeks ago at Stanford, and he says that there is an Arab proverb that when the dog barks, the caravan moves on, meaning that you don't want to listen to all this weather talk, all these other things, which conversely means that they're not going to reverse course until it's way too late. They have already decided to be behind the curve in whatever happens, and notably on a kind of overarching themes, they have agreed and promised to be behind the curve in raising rates if inflation becomes a bigger problem. And so that's the sort of thing that we can count on rather than whether we'll taper 5 billion or 10 billion or whatever the taper amount is of the day.
But you don't think the housing market's going to get better from here then? You think it's going to go down if they keep tapering?
Well, the best thing that can happen to us is that we'll continue in this muddled-through environment. The worst thing that can happen to the world is economic growth, that we actually have some of these policies succeed. Look at the Japanese to understand what's happening there. If they are rebuilding Tokyo for the Olympics, if they ramp up military spending, what do you think is going to happen to the bonds over there? Bond prices would plunge, makes it impossible to finance government debt. Well, fear not, the Bank of Japan is going to step in to lower the cost of borrowing. Now, you think that's just the Japanese? Look in the U.S. In 10 years from now, the CBO, the Congressional Budget Office, suggests we might be paying over $1 trillion more a year in interest expense alone if we were to go up to the historic levels that we've been paying on our debt as a government. We can't afford that. And so in the US, just as in Japan, we have an inherent bias to keep real interest rates low to negative. And so, and that's the sort of environment we'll continue to be in, despite, no matter what she talks about, Janet Yellen says on a daily basis about helping Main Street or not.
Can this blow up? I've seen a lot of chatter on the internet about bail-ins. Ellen Brown is out with a new thing about European bail-ins, that the economy that could just suddenly take a nosedive, and we could have, bank holidays and bank closures. Do you see any of that on the near-term horizon or this year?
Well, what could possibly go wrong when the stock market goes up every day, right? I mean, asset price inflation means that asset price inflation can reverse. You can have a collapse in asset prices at any time. You saw it in gold a little bit in April of last year. There was just no bid out there. And the same thing can happen in the equity markets, of course. Now, conversely, you talked about Europe. We're actually far more positive on Europe than many. And that is because risk is priced locally. Yes, you can have things blow up. When Cyprus blew up, well, Spain had a treasury auction where they paid the lowest yield since the early 90s. That's what you want. You want failure to be A, possible, and B, localized. Similarly, in the U.S., we have bank failures all the time. The FDIC is seizing institutions, but you don't have a currency crisis necessarily. So blowing things up isn't necessarily a bad thing. The problem comes in when there's too much leverage. And sure enough, people are encouraged to use leverage. Well, you saw it in China, banks playing arbitrage between onshore and offshore renminbi. And of course, you gear yourself up because the volatility is so low. Well, when volatility explodes, you have a problem. And so, yes, the blowing up part is part of capitalism, except when you drive it to excesses because governments make promises, then you can have bigger problems on your hands.
But you think we could have a meltdown this year?
Well, meltdown is an overstatement. I think we can certainly have a crash. Central banks are there to prevent meltdowns. It's this put option that central banks put out there. They will always provide liquidity. Central banks, and they've shown it over and over again, they can keep a zombie banking system afloat because they can always provide liquidity. They cannot provide solvency, but they can provide liquidity. That's what happened at the Fed in 2008. It happened in the Eurozone for an extended period. And so a meltdown scenario is less likely. But sure, you can have a very significant problem when you have some of these markets have dislocations.
Well, you are German by heritage. I love your accent. And you were talking to me in the pre-interview that, 23% of Germans want to have sanctions. So you know where that's going. And I did a little research, and 6,000 German companies are doing business in Russia. Well, France has the economies over there aren't great. I mean, Germany's probably better than most, but France's economy is not great. I mean, they have all-time record unemployment. UK just cut a gas deal. Well, they did it in 2012, but they're just now getting the gas from Russia. They don't want to have sanctions. What's up with the U.S. and Russia fighting match where Russia wants to stop using the dollar? They want to have their own MasterCard. They cut trade deals with China. They cut trade deals with India. Couldn't that crash the dollar?
Well, yeah, let's talk about Ukraine a little bit. Let me give you another anecdote here. So only 23% of Germans like to have sanctions against Ukraine. The former German chancellor in the early 1980s, Helmut Schmidt, he was quoted the other day. He's a guy who doesn't give a darn about the news. He smokes on camera every single time. And he said, what's all this fuss about? He doesn't even know whether there's anything illegal about the annexation of Crimea. I'm not suggesting that's the general German attitude, but there is not going to be any significant sanctions with all these businesses dealing with Russia. Now, with regard to the other point, of course, the one takeaway from the Russia situation is that over time, Russia will sell more gas and oil towards the east than towards the west. That's really the only implication from all of this. And that comes to your point about using the dollar versus using the renminbi or other currencies to transact. And that happens, and it's been happening. It's just not something where you turn a switch and from day one to another, it's changing. It's something that's happening gradually. Think about a frog in a boiling pot. The dollar has been on the decline for many, many years, and it's going to continue to happen, and many people will just say, no, it's never going to happen. because as the Eurozone crisis has abated, the euro is again a popular currency to diversify reserves to. And the flip side of it, of course, the Chinese don't have quite as many reserves to deploy as they have to take care of their own issues back home. And so, similarly, by the way, as we have this quote-unquote rising interest rate environment, the pundits say that that strengthens the dollar. Well, no way. Historically, it doesn't. When interest rates go up, the Treasury market is in the bear market, provides a disincentive to buy dollars, and it's in the early to mid phases of a tightening cycle that the dollar historically weakens. It's in the late phases of a tightening cycle that the dollar benefits. And so if you add to that the geopolitical situation, there are lots of reasons why the dollar might weaken. And sure enough, maybe it doesn't happen, but the important thing is there's a risk that that may happen, and investors may want to take that into account in their portfolio allocation.
Well, let's talk about precious metals, because evidently that's one of the ways you could make money on the Yellen Fed, at least in the long term. Silver Eagles at the Mint are outselling gold Eagles at 300 to 1 or something. Well, what do you make of the gold and silver physical market?
Well, sure. I mean, people talk a lot about conspiracies in these markets, and I don't subscribe to these theories as much because every market is kind of the same in that sense. We just, in the gold market, we talk about it more. And when you deal in a paper market, you have people using leverage. And sure enough, when gold goes up for 12 years in a row, guess what? Some people use leverage. And so there has to be liquidation when the price plunges. That doesn't mean there isn't any demand there. And of course, I don't think of it as manipulation. I think of it as an opportunity. Well, if you want to have the physical, now is the time as the prices are lower. And that's exactly what you see in the market. While the paper market is deleveraging, that provides an opportunity because the nominal price is lower, and it's a buying opportunity if you want to buy the physical. That's exactly what's happening. That's why there are shortages.
Well, with silver, though, why the way out of proportional demand for silver eagles as opposed to gold eagles? Do you have any thoughts on that?
Well, silver is the poor man's gold, of course. I mean, it means that potentially the demand is spreading to more people. You have to pay $1,300 to buy a coin of gold, and so it is much easier to buy a silver coin than to buy a gold coin, and so that's just by the law of numbers. Simply, it is natural that people, when the initial demand is going to be there, and then if you want to deploy quote unquote real money, bigger quantities, gold is a lot easier to store.
Well, let's just touch back into the Russia, Ukraine, U.S., EU situation there. So could this thing get nasty? I mean, you had all these, upwards of 100,000 Russian troops on the border. You have Lavrov, the counterpart to Kerry, talking to, them having a big meeting. They backed some troops off. But I just don't think Russia's going to back out of Crimea. They're not going to give up that port. And I think the stage is set for exactly what it is. Do you think this could turn into a wider war, or do you think this just fizzles out?
Well, two things. I think this particular incident is going to fizzle out, but I think we'll have other problems elsewhere in the world. And let me touch on both of these. Putin shows you how it's done. I mean, you set the facts on the ground, and then you invite everybody to talk to find a way, quote unquote, forward. And the sanctions are not going to happen. And so these are the sort of things that will happen as Russia is firmly embracing Crimea and it's going to be annexed. But to the broader point, I think, Ukraine is a symptom of an increased political instability throughout the world. Ukraine has a problem no matter whether they're associated with the East or the West. They have too much debt. We have too much debt in most parts of the world. People are dissatisfied. Here in the U.S., we have the rise of the Tea Party and the Occupy Wall Street movement. In the Middle East, you have revolutions because people can't feed themselves. In Japan, a populist prime minister is elected. All of these are the result of the same phenomenon. Too much debt in the world, and policymakers never blame themselves. They always blame somebody else, either the rich or foreigners, and that sort of thing increases instability throughout the world. So over the next 10 years, we'll see many more things, and Crimea happens to go comparatively peacefully, but bigger crises are bound to come in the years to come.
All righty, Axel Merk, I appreciate you coming on today and giving us, I knew this would be you talking sound bites. Did you miss anything that you wanted to talk about? I know this is a shorty, but did you miss anything?
Can talk about many of the things, including the euro, for years, but I think we'll make this soundbite length, and we'll chat again in the near future and have another discussion.
You're a buyer of gold and silver. You're a holder. You're a holder of that as a core asset.
Yes, that's particularly gold. Yes.
Particularly gold. Okay, Axel Merk, Merk Investments, thank you so much for joining us today on USA Watchdog.
My pleasure.